Every great investment begins with a decision. Some decisions are straightforward, others are made in moments of uncertainty when markets fluctuate, headlines dominate the conversation, and the future feels impossible to predict. In today's rapidly changing world, where global events can influence financial markets in an instant, the ability to make thoughtful, informed decisions has never been more important. Which brings us to one important question: how do we make confident decisions when certainty simply doesn't exist? A very good evening, everyone, and welcome to tonight's exclusive masterclass on making decisions in times of great uncertainty. I'm Ronald Sarmiento, Senior Program Counselor at the University of Manchester, Dubai, and it is my pleasure to be your host for this evening's session. Whether you are an experienced investor, a business leader, an entrepreneur, or simply someone looking to make better decisions in an increasingly unpredictable world, tonight's discussion offers valuable perspectives that extend well beyond investing. Joining me this evening is my co host Samreen Hassan, Program Counselor at the University of Manchester, Dubai.
Thank you, Ronald. Uncertainty is a shared reality, not just in the markets, but across business, leadership, and our everyday lives. While we cannot always control shifting circumstances, we can absolutely master the discipline required to navigate them. This is exactly the focus of tonight's masterclass. By bridging the gap between academic research and real world investment experience, we are here to help you unpack risk, conquer uncertainty, and make high stake decisions with absolute confidence. We are incredibly grateful you have chosen to spend your evening with us to get the most out of the season. To get most out of the session, we encourage you to stay highly engaged, challenge your own perspectives, and focus on how these ideas apply directly to your professional journey. Now, before we officially dive in, we would like to take a moment to introduce the institution making tonight's learning experience possible. Our next With a proud heritage dating back to 1824 and a founding member of the prestigious Russell Group, the University of Manchester is built on legacy of world first. It is a global powerhouse of innovation, proudly associated with 26 Nobel Prize winners and revolutionary milestones like splitting the atom and discovery of graphene. Today, the same standard of excellence shapes Alliance Manchester Business School, where we translate cutting edge research into practical boardroom execution. Beyond rankings, we are especially proud the University of Manchester is ranked #1 in the world in the Times Higher Education Impact Rankings, recognizing our commitment to creating meaningful change through education, research, innovation, and social responsibility. Tonight, we are reminded that true leadership isn't just about what you know, it's about the positive impact you leave behind. Next slide. That relentless spirit of excellence is deeply rooted right here in our region. Since establishing the University of Manchester, Dubai in 2006, we have been empowering professionals across the region with a world-class education. This year, we are incredibly proud to celebrate 20 years of excellence stronger together, honoring the incredibly diverse community and powerful global network we have built across our students and alumni. Through our internationally recognized master's, MBA, and executive education programs, we continue to develop leaders who make a meaningful impact. Most recently, our official institutional licensure and program accreditation in the UAE further reaffirms our unyielding commitment to delivering the absolute highest standards of academic excellence. Next slide. Now, if you're not quite ready to commit to a full-time 2 years program, our executive education programs offer the perfect flexible alternative. Designed for fast-moving managers and leaders, these courses are delivered in an intensive face-to-face format over just 4 to 5 days. What makes this track unique is its modular flexibility. Each course can be taken individually to solve an immediate business need or combined over time to achieve a prestigious Manchester Professional Diploma in Leadership. Participant will also receive a digital recognition for each course completed, making it a flexible and impactful way to accelerate your professional standing. Investment for these specialized courses begins at up to 5,500 sterling pounds, giving you world-class Manchester expertise on a schedule that respects your time. Next slide. Please see our next set of courses and avail 15% discount. I'll give you a few seconds to scan it.
Thank you very much, Samreen. And now it gives me a pleasure to introduce this evening's speaker. He is a lecturer of practice at Alliance Manchester Business School, the University of Manchester, where he serves as course director for the International Business Consultancy Program and lectures in banking and investment. He is also a chartered member of the Chartered Institute of Securities and Investment, or the CISI, and holds a master's degree in the law of international financial regulation. He built an impressive career in financial services, holding senior banking roles with Barclays Wealth and HSBC. Today, he is widely recognized as an expert in the financial services industry, having served as an expert witness in more than 200 investment mis-selling cases. In recognition of his contributions to the field, he was named Derivatives and Financial Services Expert of the Year in 2016. Please join me in giving a very warm welcome to Professor Martin Berkeley. Professor, good evening.
Good evening. Thank you very much for that warm introduction, and good evening to everybody. I do appreciate you taking time to be here. I'm going to try and share my slides. If I'm getting it wrong, please tell me, and we can make sure everything is working. 2 seconds. Okay, can you see that?
Yeah, we can see
Yes.
the slides.
Marvelous. Well, firstly, thank you for the introduction again. If I speak too quickly or you don't understand my funny accent, please tell me. No problem with that. I would rather take questions at the end, and I hope we have a good discussion. But if there's any quick questions, please put them in the chat, and somebody will let me know what I've missed or what the query is. It may be I'm going to cover something along the way. Broadly speaking, this talk is based on a program called Practical Investing, which we run on the Global MBA. It's a 6-month program, so I try to compress quite a lot of material into quite a short time. But hopefully, it will give you some interesting takeaways to take away and think about how you invest. Well, you open the newspaper, there's a headline that doesn't make any sense, or everything's going up, going down, oil shocks, global uncertainty. Investing feels really difficult now. But actually, I think it's difficult most of the time. I think the only time it's really easy is when everything is calm, prices are moving up, but then something suddenly happens that affects everything. The long-term market trends are difficult to anticipate. We do get volatility, share prices moving very quickly around crises. And sometimes nothing happens for a while, particularly, and then there's a load of volatility. And I've got some slides that will illustrate that. The news can be informative, but also there is too much information as well. Is there a question in the chat there already? Do you get the slides later? One of my colleagues will answer that. The impact of AI, it's going to have an impact, of course, and I look forward to discussing more about that. There's usually some good conversations on that. And who can you trust? little bit about me. I've done all sorts of different things. I'm pretty ancient. I was working it out. I've been investing for about 45 years myself. I've got it right sometimes. I've got it wrong quite often as well. So if you take away anything from this talk, it's about how not to lose money as well as hopefully to make money. Right. This is to get you thinking. Who would you take financial advice from? Who would you take investment advice from? Anybody recognize these two individuals? Put it in the chat or shout out. Everyone's a bit shy. Well, in case you don't recognize them, the person on the left is Kim Kardashian, who is a model influencer, whatever that is. And the other one is a gentleman called Bernie Madoff. Why have I put them up there in terms of financial advice? And why would you possibly use them? Well, Kim Kardashian was fined $1.26 million for unauthorized financial promotion of a cryptocurrency. Bernie Madoff, well, he went big time. He had the biggest Ponzi scheme, so a fraud in the world, and he was sentenced to 150 years in prison and 170 billion pounds in restitution, effectively fined. He was a highly respected member of the financial community. He was chair of various financial bodies. Lots of people sought him out for investments. He didn't take everyone on board. So you've got a very experienced and renowned investor one side, and you've got an influencer the other side. So who would you take advice from? In the long term, on the top, sorry, this may be a bit small, we've got the Standard & Poor 500, which is basically the index of the major shares in the USA. And we've got something called the VIX index, which I'll come to on the bottom. Basically, what it's saying is over the long term, shares do really well. And more recently, I can't quite read the scale myself, they've gone up extremely well. However, the markets have been very volatile underlying that. And the VIX index is a measurement of fear, if you like, in the market. On the course, we talk a great deal more about this, but basically you get shocks in the market. And some of those spikes, for example, would be the global financial crisis or COVID or something like that. And that can have a massive impact on your share returns when you're buying. So it's difficult to make decisions at the right time. So we're talking primarily about the stock market here, but we're going to talk about other things as well. There's a great saying by a famous investor called Benjamin Graham that the financial markets are a voting machine. Do we think this is good? Yeah. But in the long run, it's a weighing machine. It's just looking at the value. I'll give you the example there of SpaceX, which had its recent launch. That was not meant to be a joke, but there you are. $1.8 trillion valuation. However, it's had to issue bonds to finance itself. These were investment grade, and now they're trading at junk status. So you've got two slightly contradictory things happening there. You've got shares that are being highly desirable and being traded, although I think they're a bit off now. But their bond, their corporate financing, if you like, is not that attractive. So what's that mean? AI companies, well, looking at the headlines in the last couple of days, the valuations are coming off on AI companies. Have they got sustainable business models? Are they really making money? Some of them will survive, some of them won't. So there's a lot of noise in the market. You've got economic noise. As I mentioned, you open the newspaper, you turn on the television, there's always some new data. What matters? Is it interest rates, employment, stock markets, oil prices? It could be all of those different things. However, what matters to you as an individual in your investment decision? We're going to come back to that. I believe the laws of economics always apply. Yeah, companies have to make money at the end of the day. They have to have cash. Otherwise, they will run out and they will go bust. However, this noise in the market can influence prices and movements in stocks over the short term. And that can be one individual going on Twitter or X or Truth Social or whatever it's called, or a particular headline. Difficult to make sense. So who's on your side? Well, is it the banks? And I'm using the term banks as a general term for financial institutions. So You've got Thomas Jefferson, the US president, saying that he thinks banks are very dangerous. And on the right-hand side, you've got the saying of Gordon Gekko from the film Wall Street, worth a watch, saying greed is good. And that's what banks do. They're there to make money at the end of the day. And of course, they are going to make money out of you. So what does this mean for you? Well, I think it's worth thinking about why you are investing. Now, presumably, this is to make money. Most of us are doing it for that reasons. Can be other reasons, can be tax reasons, for example. And you need to think where you are, not only geographically, but in your life cycle. So this is perhaps a little bit small, but typically on the left-hand side, the green side, people that are younger could take higher risk because they've got longer to recover. And on the right-hand side, you tend to try and de-risk your portfolio. Unfortunately, I'm a little bit further to the right than I would like, but there we go. So on the left, broadly speaking, you're building up your wealth. In the middle area, you're consolidating it, but perhaps you've got some big costs. You're buying houses, you're paying for education, you're thinking about family. And on the right-hand side, you're thinking about how do I get rid of that in a tax-efficient manner? Yeah. What happens to inheritance? And there could be some really interesting questions about inheritance. For example, what happens if I give lots of money to my kids? Will they do nothing? Will they become lazy? Will they spend it all on fast cars? That could be a real issue. I think the key takeaway here is start early, invest often and gradually, and try and manage the risk in an appropriate manner. There's a very simple bit of maths at the bottom that you can check it. Compounding is really very, very powerful and works in your favor. If you invest £10,000 for 40 years, adding £2,000 per annum, that would be worth at 7% growth, just over £550,000 on its own. That's without other things going on. So the regularity and the early starts are really important. I'm seeing a few things come up in the chat. Okay, nothing, no questions there. Right. Very importantly, how not to lose money. Losing money is really easy in investing, and I've done plenty of it. Making money is a little bit harder, but it is very easy to lose money for a bad investment, but also to scams. Okay, you need to look carefully at what you're buying, due diligence. So I'm going to give you a couple of examples, a little bit extreme, but hopefully it illustrates the point. Okay, these are some real company accounts from the UK's Companies House. Have a look at those numbers there. I've highlighted in yellow and red. What strikes you about them as possibly being a little bit odd? This company still exists. It's still on Companies House. I couldn't actually work out how many zeros there were. That's £49 trillion of cash and net assets of 100 trillion. Sounds a bit odd? Well, that values them at 30 times more than Apple. This was a fraudulent company, and actually, they have been held to account. The reference to that in the slides, you can find the link at the bottom there. But yes, this was a company that reported to Companies House and had artificial or fake numbers in it. Another example for you. I was approached by a company that wanted to promote a global healthcare opportunity to me. I know a little bit about the healthcare market, so I kind of went along with it for a while, and they sent me the documents and we had some conversations, and I think they got a little bit excited. I was gathering information over time, but as part of my due diligence, I looked at the information they sent me, and the thing that really struck me was, well, a lot of it was frankly rubbish, was where their global headquarters was. Thanks to the power of Google Maps, I looked up their global headquarters, and this is a picture of it. It was a little house somewhere in a little town. The company was registered to this address. I don't know if the individuals even knew that. It wasn't a big global healthcare opportunity. So look very carefully at what you're buying. And having slated banks a little bit a few moments ago, it's worth looking at who is promoting the investment. Generally, reputable financial institutions will promote sound investments, hopefully. The perhaps more exotic ones are often less sound. The usual sell is we can get you great returns, but for that, you're going to take great risk. Okay. So what can you control? You can't control the market. You can't control the news. You can't control what prices are doing. You can control costs. Another story for you. In, I think it was 1930s, this book was published by Fred Schwed called Where Are the Customers' Yachts? And it's a lovely story about how an investor goes to see his broker in Wall Street in London, in New York. And they go and have a fine lunch, which of course the customer was ultimately paying for. And after lunch, they go for a walk and they go down to the river, the Hudson, and they look at these beautiful yachts. And the broker says, look at all these beautiful yachts. They belong to the brokers. And the customer is very impressed, says, yes, they are beautiful. They're amazing. And he asked, where are the customers' yachts? Well, that's the point. There aren't any customers' yachts. Yeah, the people making money are the brokers, the banks, the people selling you the investment. However, that being said, investing does cost money. And to construct some investments does cost a great deal in regulation, those sorts of things. But at the end of the day, who is benefiting? The person selling you the investment and or the investor themselves trying to make money. And why does this matter? Okay, well, costs can have a big impact on your returns. So this is a very simple example. If you were to invest £10,000 and hold it for 30 years, not an unusual term for a pension, it would be worth £52,000. If you're paying an AMC, that's an annual management charge, 0.3%, and it would be worth £12,000 less if you're paying 1.2% annual management. The fee, there are other fees as well, but this just gives you an example of the difference. And this is actual data from a company called Vanguard, who kindly have given me permission to use their slide. The famous investor Warren Buffett said this about fees. I'll let you read that, but broadly reinforcing what I'm going to say. Portfolio turnover. What does this mean? This is how often assets are sold within a portfolio. Portfolio being a set of investments, how quickly they are sold. And if it can be actually illegal, it's called churning and switching, but you can do it yourself as well. I bet some of you who hold shares check them every day. And if you're on a trading platform, they will encourage you to try and look at your portfolio. The reason being, the more you trade, the more money they make. However, the more you are likely to destroy your own value. So buying shares and setting it up correctly is the key. There is lots of data to support this, that broadly speaking, the higher your portfolio turnover, the lesser returns you're going to get. Okay, so here's some data to support that. There we are. The more you supporting that, the more you turn over, the lesser returns you get. Some platforms actually will charge inactivity fees. So if you don't trade in a certain period, they will charge you a fee. Okay, how do you make sensible decisions to make sensible investments? Well, actually, I don't think there is a system. Some people sell systems, and I think the people that sell trading systems are the ones that get rich. There is a sort of set of principles you can apply and tweak to your own particular set of circumstances. That's what I'm going to touch on now. We should base decisions on the long term. So that's running from 1979 to 2011, and you have the world index, if you like, running at a level of, I don't know, between 6 up to sort of 18%, and then dropping down as well, the global financial crisis. But broadly speaking, within a relatively narrow band. So you need to take a long-term view of where the market is. However, we tend to base decisions on the market volatility, and this is actual market volatility expressed in an annualized way. And that can be very difficult. However, this can create opportunities. So, for example, when there's a dip, that's the cheapest time to buy. However, it can be the most difficult time to buy because the markets are going a little bit crazy. When we invest, we very often go through a cycle of emotions. And I'm grateful to Kinesis Labs, and we have the managing director that generally speaks on the course for this slide. And if you could apply this particularly to any new investment, so if we take AI as an example, there's lots of optimism and excitement that this is the new great thing. It's going to be fantastic. I bought shares; they're just going up. I've doubled my money. Then they start to come off. No, they're not. They're going to come back. Oh, maybe they're not. Okay, I give in. I've lost money. And then things start to improve again. It tends to be a cycle. Behavioral finance is fascinating. We all are very good at making very poor decisions. There's lots of reasons for that, but it can be over optimism, lack of understanding. You need to look carefully at why you're investing and when you're investing and whether you are behaving in a way that's actually destroying your own value. Anyway, maximum financial risk and maximum financial opportunity. So when the market is at a peak, that's very often when people buy. For example, gold has been very high recently, and more people have been buying gold. It becomes a self-sustaining momentum, if you like. I will put my hands up and say, I have been wrong about gold for years. I thought it's reached a peak, so I haven't bought it. But I've been wrong. I've missed out. But so what? But when it drops, that's the time when it's good to get a bargain. You don't know everything. You cannot know everything that's happening in the market. You will not know as much as the banks, the brokers, and there is a whole canon or theory behind why share prices move in a certain way, that they can be random. Lots of other drags on your returns. A couple of examples there. Prices behave in an irrational way. So when some news comes out, the market will overreact typically. Too much, too high, or too little. Or it actually may not react at all. And you're thinking, why? And that is probably because the market has priced something in already. So you may have seen this where a piece of information comes out about a company, earnings are on target, and the share price actually drops. Why is that? Well, that can be traders unloading their position. It can be the market's priced it in already. But over time, it tends to find its natural level. AI, I think, makes this worse. You've got algorithmic trading happening already. So if levels hit a certain trigger, the computer will execute trades which can exacerbate any swings in the market. There was a very famous financial crash called the flash crash, which I forgot which year it was, and I think it was JP Morgan. But broadly speaking, their algorithmic trading caused a crash in the market because it moved in an extreme manner. So how can you invest? How are we doing on time? Excuse me one moment. Well, a good place to start is people that have been good at investing for a long time. It is really hard to beat the market in the long term. It is possible to do it in the short term. That's where trading happens. That's very different to investing. But over the long term, there have been very few investors that have outperformed the market for decades. And there's some examples. And during the course, we study these in some depth. They focus on the long term and they have their different approaches, but they tend to be very, very disciplined. They think carefully about their behavior. They don't necessarily follow the trend and they manage their risk very, very carefully. So if you want to find good ways of investing, study the greats. Good place to start. How do you build a resilient portfolio? Well, by that, I mean a set of different investments that are going to perform in slightly different ways. Some will underperform, some will overperform, but you're balancing your risk. So you need to think about why you're investing, how long for, how much can you afford to lose? Because there is a real possibility if you need to get your money out when the market has crashed, you're going to take a big loss. You need to basically spread it around, diversification, asset allocation. I'm going to say a little bit more about that. Manage your costs. Time is your friend, okay? But you also need to keep a view on what you're doing. Is it still right? But also to measure it. Am I doing well? And people can make very complex systems of measurement. I'm a great believer in so long as I'm doing better than I was or out beating inflation, I'm okay with that. Because over the long term, it should be fine. You have to balance your risk, your reward. It's amazing the number of people that don't understand or forget this simple concept. The higher the reward, the higher the risk that goes with that. And when we think back to those slides earlier about some of the financial frauds, people are often attracted by high return investments, which are incredibly high risk. They may be told they're not high risk, but they are. And they will often put a huge amount of their wealth in one particular investment. And putting money in one thing is very risky on its own. And of course, lower returns is lower risk. And it's getting that balance right. So how do you do that? Well, this is perhaps a little bit difficult to read, but if we take 2025, European equities were the best performing. 2024, it was US equities, and 23 US equities. But if you look at something like commodities, they did really well in 2022 and they returned basically nothing in 2023. So returns are very variable over time, and it's almost impossible to predict what is going to do well next year. So what does that tell us? Well, you need to spread your investment between these different asset classes to balance that risk. You will have to give up some return to manage that risk. Okay, so these are typical asset classes, famous pie chart. So the red being developed market equity, the right is smaller with 40% in that. But broadly speaking, you're putting them in different things which behave in slightly different ways. And classically, the one on the left would have more exposure to equities, would be seen as higher risk. So perhaps for the younger investor, whereas on the right-hand side, lower equity exposure, so exposure to other things like commodities and bonds, that would be seen as lower risk, perhaps. So perhaps for the older investor. Asset allocation is simply spreading your investments across different asset classes. Lots of different tools online you can use to help you with this. It's getting the best return for the least risk at the end of the day. It doesn't have to be shares. You can invest in other things as well. There is a whole market in Lego I discovered recently. It's a reference to the website there. Handbags do quite well, classic cars. You can invest in property. You can invest in education. Actually, I think you probably need to invest in a whole load of different things. If you've got a particular interest and passion, yes, sure, follow it, but don't put it all in one thing. Diversification. Well, this slide summarizes it quite well, but actually in the US, a small number of stocks have created most of the returns over the last 100 years. And actually, if I look at my own portfolios, I realize I've got quite a heavy exposure to some of the big US tech stocks because some of the things I bought replicate the same holdings as well. So for me, it's a lesson I need to de-risk and diversify as well. Yep. Stocks are a fantastic investment, but the individual stock is not necessarily a fantastic investment. Home bias. What do I mean by that? Well, we all tend to invest in things we know and we're familiar with. And I'm guilty of this as well. So in this example, European investors hold 74% of their assets in the European region. And it's the same in other areas as well. So you're not spreading your risk. There is a concentration of geographic risk, and you're missing out on potential returns as well. It can be difficult to invest elsewhere. You don't have the knowledge. That's where you might want to use a specialist fund, somebody to do it for you. Little bit of theory for you. The course I teach on is called Practical Investing. We keep it very, very practical, but a bit of theory as well. The whole idea is that the perfect portfolio is balancing risk against return. So you're balancing how much risk you're getting for your given portfolio, giving you the optimal return. And again, there's a load of data on the internet that can help you build a portfolio. There's a classical paper that's called Markowitz, which the reference is on there. I've got a feeling I may have got a Nobel Prize for it. I can't quite remember. Okay, so back to our portfolio and how do you put it together for you? What are you trying to achieve? Yeah, how are you going to get there? Can you manage the charges? How are you going to measure if it's any good? Have you got any constraints? Have you got any geographic constraints? Have you got any sectoral constraints? You may not want to invest in certain industries. You may not want to invest in oil, for example. You may be very risk averse. You may be prepared to take more risk. and what types of things you're going to buy. These are all things you need to consider and think about and keep under review. Different ways of investing. You can buy direct shares, you can buy funds that actively invest on your behalf, or you can buy exchange traded funds or other funds that are more passive, so they track the market. And typically, these are lower cost. So with these, you will always get slightly under the market because you have the market minus costs. The active investments, they struggle over time to outperform the market. However, some of them do quite well for short periods. And there is a big debate in investment about which is the right one. I think it's the wrong debate. The answer is you probably need a bit of both. And exactly what you need depends on your own particular circumstances. Okay. Some rules for helping you make decisions in uncertain times. You will not consistently beat the market. Give up trying. News creates noise and uncertainty. How you behave matters more than particular forecasts. Time is your ally, can help you. Think very carefully about what you're trying to achieve. Control what you can. For example, costs. There is no right answer. Yeah, there's no perfect system, but you could do a lot to prevent yourself destroying your own money. Thank you very much for your attention. I am very happy to take questions and have a discussion. Can I stop sharing now? There we go.
Yeah, thank you very much, Professor Martin. So we're inviting all our online audiences, to share with us your questions through the chat box, and Professor Martin will be happy to answer them all.
Okay, let me see if I can see the chat. Where are we? I
Yes, so Professor, I got one question here
Yeah,
at the
go on.
beginning of your presentation.
Sure.
The question is, what is the meaning of junk status?
Oh, junk status. Yeah, junk bonds. Basically, bonds are classified in different sorts. At the top, you have investment grade, which are the lowest risk. And there's different categories, but basically at the bottom is junk. So they would be called high yield, typically. So you are expecting a higher return because they're higher risk. And they're often known in the market as junk bonds. People make money out of it. It's a specialist market. But good question. Sorry for using jargon.
Mm-hmm. Okay, thank you very much. I have one more here, Professor.
Yeah.
I'm just confused with this question because he mentioned here, can't I put my investment in a diversified global ETF and
Yep.
forget about it?
That makes perfect sense to me. Actually, that's what some people do. Just for those of you not familiar, an ETF, an exchange traded fund, it's a passive fund. A global diversified one means it's spread across different markets. And actually, putting it in something sensible, safe, and forgetting about it is not a bad strategy. You might want to do something else on the edge to get excess return, but having majority in something like that is a good approach. I do quite a lot of that myself. I am guilty, though, of trying to get into other things as well. But yeah, that strategy works for a lot of people. Very sensible.
Okay. Any question from your side, Samreen? Any?
There's another one there, which is how we can identify time to exit a trade. Oh, that's $1 million question. It's really difficult. Usually, you either exit too early and you miss out, or you exit too late and you lose out. If you get it right, I think there's a lot of luck. It's a little bit like people that say they predicted the global financial crisis or next financial crisis. Everyone with hindsight predicts it, but very few people beforehand predict it. I don't know the right answer for that, I'm afraid. I've got it wrong, but plenty of times.
Professor, I have a question.
Yeah, sure.
So basically, I just wanted to know that what is one simple habit that separates successful investors from people who lose money in volatile times?
Patience. Patience. Have it, either patience not to make the investment because it's not the right time, or patience to hold it, sit it out. And it can be absolutely the right thing to do to exit an investment, but generally over time, the stock market tends to outperform. And there is plenty of academic research that shows that.
And we also have a question about how do you stop yourself from panicking and selling everything when your portfolio goes into the red?
Yeah, absolutely. I'll tell you a story. My colleague at Kinnersley Labs used to be the head of behavioral economics at Barclays Wealth, and he applied some research that basically said the more people check their portfolio, the more they're likely to panic and sell their money, sell their assets and lose money. So they introduced a system whereby they didn't give statements so often. There's certainly regulations about how often you have to introduce statements, because the more you look at your portfolio, read your statements, the more you're likely to do something and destroy value. However, customers absolutely hated it. They really wanted to see it more regularly. So it's human behavior. We want to think we can control it. So yeah, it is really difficult. At the end of the day, I don't have the right answer. It depends on the individual. I've got a stock I bought recently, probably about a year ago, and it's doing really bad. I'm not going to tell you what it was. And I've gone through this cycle of thinking, should I just sell it and get out of it now? And actually, I've gone around the other side thinking, I'm just going to tough it out. It's only a small exposure. So we're all guilty of it. Pedro, you've got a question. You can shout out if you like.
Yeah, we'll unmute Pedro.
Okay.
Sam, can we unmute Pedro so he can ask his question?
Yeah.
He is allowed to speak. He has to open his mic.
Okay.
Pedro, can you unmute yourself and ask your question? Pedro,
Okay,
are you with us?
I think while waiting for Pedro, I have a question here from Amani Taha, professor. The question is, how do you know which is the right time to invest? And how do you look at timing?
Oh, again, it's a tough question. There's this idea that you shouldn't try and time the market. You should just invest and sit out long term. And the share I was talking about that I managed to buy, and having told you not to buy individual shares, I bought an individual share. I thought market timing doesn't matter. And of course, I bought it, and then they came out with some news and their share price really tanked. So actually, in a way, market timing does matter. There is a way around this, which is this idea of dollar cost averaging or pound cost averaging, where you're dripping investments in every month. So the idea is it kind of smooths out any volatility. And it's quite a good way of just putting aside, whatever you can afford, $10 a month, $50 a month, and watch it go into something. And it will, over time, do quite well. Yeah. If you're trying to guess the market, it's really hard. You will get it wrong. Sometimes you'll get it right, but most of the time you'll sadly get it wrong. Yeah, it is really tough. It's the other side of when you get out of the market. I don't know. You maybe should get out of the market when you're uncomfortable, but maybe that's the time to get into the market when share prices are low. You've got to be brave.
Okay, thank you very much, Professor. I have here another question. What happens if you don't invest and you compound your savings in a savings bank account?
Yeah, there's a lot to be said for that. However, your big problem is inflation. So let's say you're getting, simple maths here, 2% return on your savings, and inflation is 4%. Basically, you're losing money over time. So inflation could be pretty destructive to cash. However, you've got to have some rainy day funds. Yeah. Things go wrong. Your washing machine breaks, your car breaks down. You need to spend some money on something. So you need to have some cash. But over the long term, cash is actually not a great investment. That being said, as a short-term investment, yes. And there are actually cash funds, money market funds that you can use to slightly outperform that. I used to have a role in something called corporate treasury, where we used to take money from businesses and put it on the money markets overnight. So, a supermarket would have a big cash balance at the end of the day. We will put it on the money markets for them, so they would get a very small extra return above the normal deposit rate, effectively. So it is it is a way. There's a question here about AI. Yeah. Okay. How is AI being used by professional investors? Well, it is being used by professional investors and it's being used by amateur investors. Um, AI is moving so fast. Anything I'm saying is out of date already. Where I think, in one way, it's very useful for the average retail investor is research when you're looking into an investment. I've actually used it myself to look at my own portfolio, and it made me think about things and think, oh, I'm a bit overexposed there, or I've doubled up the risk there. So it can be useful as a tool. Um, Whether you want to outsource decision making to it, that's another matter. Some banks are. We have AI investment funds, we have AI hedge funds that are making investments on behalf of individuals. It's the other side of algorithmic trading. And we will see more of this without doubt. However, I do think this is storing up a risk. Things may go very well, but when they go wrong, they will go wrong very quickly. So absolutely, there is a place for it for both professional and retail, but handle with care. There was another
One
question
more
there. Sorry.
question. Do you
Yeah,
have
sure.
any books you recommend to learn?
Ooh, there is lots of books. There is some reference in the presentation. Um, I would definitely recommend the classical the classical investors, Warren Buffett's shareholders letters, which I think I referenced somewhere in there. Some really good advice. I've got plenty of books on the shelf. It's hard to pick one out. Um, I would just say wider reading, not just about investment, about individuals, about society, about economics, about history in particular. History tends to not always repeat itself, but it tends to chime. We get booms, we get busts, we get people piling into markets. I've been around long enough to think, well, we've got the AI boom. It'll come, it'll go, and it'll be something else. A few years ago, it was crypto. And then we've had we've had the IT boom and various other ones. And if you look at the history of financial crisis, there's often a boom before there is a bust. So unfortunately, human nature tends to be like that. So look at history as well. Look at human behavior.
I have a
Okay.
question.
Oh,
Sorry,
yes.
Ronald. Please go ahead. Ronald,
Okay.
please go
Okay.
ahead.
Yeah, I have a question here, Professor. Question is, how do I handle behavioral biases?
I think the first thing is awareness. If you know you're going to have a bias, and I know I've got some, you can be aware of that and try and avoid it being a negative bias. The I think he's a psychologist, Daniel Kahneman, is actually very interesting also on our own biases. But I think awareness of them, but also awareness of how it can distort your own views. So there's this idea of survivorship bias. So if somebody presents you with a set of investments and says, well, these have outperformed over, we've got these 5 funds and they've outperformed over the last 10 years. What they may not be telling you is actually they had 100 funds and they are only presenting you the 5 that have outperformed. The other 95 haven't outperformed. That's survivorship bias. Yeah. So be aware of how information is presented to you as well.
Thank you. Samarin?
Yes. So I have a question. What is the
Yeah.
easiest way? So the question is for a beginner, basically. So what is the easiest way for a beginner to diversify a portfolio during a crisis?
Oh, should you? Well, let's unpick that a bit. Beginner, that's fine. Nothing wrong with that. Diversify during a crisis. While that suggests you're selling and buying something else, what's the right thing to buy during a crisis? I can't tell you. I don't know. Yeah. Should you be selling during a crisis? Well, if you need to, you have to. But in a way, I think you've got to tough it out and take the long term view. So I think it takes quite a lot of courage. So investing, perhaps no more than you could be prepared to lose or be comfortable with, and also how it affects you as an individual. If you're going to lie awake at night worrying about your investments, I think you need to do something very different. You need to invest in the safest, most boring thing going because it's causing you a level of stress. Okay. I have a friend who he he had quite a good portfolio, and he used to get very stressed about its volatility. So what he did was he sold it. He sold it at quite a good time, and he bought himself a beautiful little cottage by the sea. Yeah, actually a really terrible investment because property requires maintenance and it's very illiquid. However, it brings him joy. Yeah. He loves going there. He loves going to near the sea and looking at the beautiful nature. And that works for him as an individual. And the stress of worrying about investments wasn't worth it in terms of return. However, buying a beautiful cottage was a great investment for him as an individual. Yeah. Doesn't work for everyone, and it could be something else. Okay. You've got to live as well. It's not just about money in a spreadsheet.
Thank you so
Another
much.
question from the chat box,
Yeah.
sir.
The AI boom is affecting
It's
most
affecting.
high-tech sectors, mainly storage. Some of the shares are skyrocketing. Are we expecting another financial crisis soon? Well, let me take the back end of that question. We're expecting another financial crisis. I don't know when. So I don't know about the soon bit. There will be one. Of course, there will be one. And there is, various economic theories that talk about trade cycles, contractile cycles, those sorts of things. Yeah, I do worry about booms. Definitely, I worry about booms. And as I mentioned, I've been completely wrong about the gold boom. I thought it was overvalued years ago. I was totally wrong. I'll tell you another market I was totally wrong about: London property prices. I thought they peaked years ago and they still seem to be going up, although a little bit off at the moment. So it is almost impossible to guess when the bust is going to happen. Often they come out of the blue, something triggers it, and it can move from a relatively minor thing and spread like wildfire through the financial system. It's called systemic risk. So you just need to, if you spread your investments across different sectors, hopefully they will not be affected the same way. And I say hopefully because during the global financial crisis, a lot of assets started to behave in the same way. Yeah, they were what's called, they became correlated. Whereas traditionally, shares and bonds are what's called inversely correlated, so they move in opposite directions. They actually became correlated, which was really quite worrying. Hope that helps a bit.
Thank you, Professor. I have two more questions here.
Yeah, of course.
So, second is, how do you distinguish between risk and uncertainty when making investment decisions?
Risk and uncertainty. Ooh, well, there's a risk that I could make a profit. Yeah. Risk doesn't necessarily have to be bad. Risk can be a good thing because you get more return with risk. Uncertainty, well, that comes down to your due diligence. Yeah. The more you know about a company or a particular investment, hopefully the better decision you'll make. And the reason I say hopefully is because if you know a lot about a particular company, you may be blinded to the risks or the sectors. I'll give you an example. If you get share options from a company, so you have shares in your own company who employ you, you're probably going to have a high exposure to one company and you understand that industry. Yeah. However, it may be a disbalance between other sectors of the market to spread the risk. A really good example of that is when I've been doing this selling cases, I've dealt a lot with property investors who know a lot about property and they get talked into buying something else. Usually quite a high risk thing because they understand property risk really well. And property can be quite high risk, but they don't necessarily understand the other investment they're being sold. And they put a lot of money into it and things go wrong. So it's balancing risk, i.e., in terms of return, risk in terms of loss, but trying to minimize the uncertainty by having knowledge. Does that help? Does that make any sense?
Thank you very much, Professor. One last question. What leading indicators would you monitor to reduce uncertainty in your investment decisions?
If I'm looking at an individual company, and having told you companies are not good investments on their own, I always look at debt levels. Are they full of debt? So they're going to run out of cash. I mean, having worked as a commercial banker, the thing I've seen that kills companies is cash flow at the end of the day. They can be profitable, but they run out of cash. So high debt levels really worry me. On a more sort of global scale, I look at things like interest rates. I look at oil prices, basic economics. How is an economy doing? Employment levels. If there's high unemployment, people have less money to spend, and it's generally bad for the economy. However, you can get these other weird things happen. Quite often, people will spend more on luxuries during an economic crisis because life is a bit miserable and they want to buy something that makes them feel better. So, looking at human behavior and human nature, this is why I say try and understand society and human behavior, because that can try and explain a little bit about what's going on. Government policies can have an impact as well. If they're going to make subsidies or trade barriers, that can certainly affect markets. There's no definitive answer there. I don't look at every single indicator in detail. I don't have enough time.
Okay, any other questions from our
Yes,
online audiences?
Yeah, very happy to take some more.
we have one question, which is what is the best approach for investment in times of war?
In times of war?
In times of wars.
Oh, well, the cynic in me would say defense companies are good places. And actually, we're seeing an increase in defense stocks at the moment. Gold is traditionally sought after during times of great uncertainty. It's seen as a store of value. It's seen as a safe haven, if you like. However, gold doesn't pay dividends. You have to pay for storage if it's physical, it has to be insured, and those sorts of things. War can create shortages, which can create opportunities as well. When I was doing one of my lectures on practical investing, I had one of the colleagues who worked in the oil industry in Oman, who said that the oil industry in Oman was doing incredibly well because they were outside the Straits of Hormuz. So whatever his company was, I can't remember what it was, had done really well. So these opportunities can be created, but it comes down to fundamentals again. What's the shortage? What's the demand? So typically, historically, during times of war, textile manufacturers have done quite well because they've had to make uniforms for armies. So you need to think about what is going on. Very difficult, very difficult. Good question, though. I like that. Have we got time for a few more?
Just give me a second.
So we have another one.
Oh,
Yes,
okay. We call this the last one, shall we?
Yeah, I think this should be the last one because we're running short on time. So this is about stock markets are being manipulated to benefit one group of investors at the loss of others. How to be smart in making those decisions when information being sold is manipulated?
Oh, that's a really interesting question. Well, you can't know everything. Manipulation is actually a crime. However, I'm sure it does happen. I think applying the first principles, spreading your risk across different asset classes, spreading your risk across different markets. If you've got information that gives you an advantage, you can use it. That could be through your own research. Insider trading, of course, is a crime in many markets. It's difficult to know if markets are being manipulated. I would suggest investing in well-regulated markets because the chances of manipulation is much lower. Can happen, but it is less. Yeah. I think that's about all we've got time for. Yeah.
Yeah. Final question, Professor.
Oh, okay.
I promise.
Yes. Yeah. Go
It's
on.
a short one. Are the booms created to manipulate the market?
Are they created to manipulate the market? I think they tend to happen on their own because prices go up. People want more, so the prices get driven up. It's basic economics. Whether it's manipulated to, well, there is things that can be done to cause market manipulation. So news, scarcity of stock, those sorts of things. I think generally not, but it is possible.
Thank you.
I thank you. Well, just a final word for me. Thank you all for your attention and your really good questions. I hope to meet some of you either in person or online at some point.
Thank you very much, Professor Martin,
Thank
for
you.
sharing your valuable insights with us this evening. And thank you to everyone who joined us tonight. We hope you found this masterclass both insightful and inspiring. If you enjoyed today's session, we invite you to continue your learning journey with us in the season 2 of our masterclass series. Over the coming weeks, we'll be exploring more timely and thought provoking topics with our world class faculty, including CEO in the Age of AI with Dr. Reza on August 12th, explore the world of MA Educational Leadership in Practice with Dr. Bobby on August 17th. Then on 24th September, we have Dr. Stephen Sagelmayer delivering masterclass on geopolitics and international business in the Middle East. To register, just simply scan the QR code on your screen, and we look forward to welcoming you back for another inspiring session. This evening began a simple question: how do we make confident decisions when certainty simply doesn't exist? Throughout today's session, we have explored the reality that uncertainty is something we cannot completely remove, but it is something we can learn to navigate. The goal is not to predict every outcome or have all the answers before making a decision. Instead, it is about developing the awareness, discipline, and perspective to make thoughtful choices even when the future is unclear.
What an incredible session. We hope today's insight inspired you to reflect on how you approach critical decisions, both as professional and as an individual. In an unpredictable world, the ability to sharply evaluate information, command risk, and execute informed choices is a vital skill that will support you across every area of life. The growth doesn't have to stop here. We invite you to continue this learning journey with us through our upcoming masterclasses and elite programs offered by Alliance Manchester Business School and the University of Manchester, Dubai. To stay connected, simply scan the QR code on your screen to follow the University of Manchester Dubai official channels to ensure you never miss our latest events, exclusive insights, and upcoming regional opportunities. While you're at it, we would be incredibly grateful if you could snap a quick review for us on Google. Your feedback helps us constantly elevate these sessions for our growing community. My name is Simreen Essen. Thank you all for your brilliant energy tonight, and we look forward to seeing you at our next University of Manchester event very soon.
The future will always carry uncertainty, but those who continue learning, questioning, and making thoughtful decisions will always be better prepared for whatever comes next. As we celebrate 20 years of excellence, we believe the future belongs to leaders who inspire others, embrace innovation, and drive meaningful change. With stronger ideas, stronger impact, stronger future, stronger together. On behalf of our founding director, Randa Besiso, Professor Martin Berkeley, thank you very much, sir, and the entire team of the University of Manchester, Dubai, thank you once again for joining us this evening. My name is Ronald Sarmiento with Samrina San and Hussam, wishing you a wonderful evening ahead. Stay safe, and we look forward to welcoming you to another University of Manchester, Dubai event very soon. Have a wonderful evening.